Hello, my fellow traders. My name is Michalis, and I'd like to welcome everybody to tonight's webinar here at IGMFX. Tonight, we're going to be looking at trade and risk management. It's something extremely important. It's not something that we've previously looked at as a part of our webinars. Today, we're going to be looking at three major sections. We're going to be looking at, of course, a quicker introduction, where we're going to be looking at IGMFX. We're going to be looking at a quick introduction to myself, to trading in general. Then we're going to start to look at trading basics, trade and risk management basics. And then towards the end of the webinar, we're going to start to get a little bit more in depth. When we're referring to trades and risk management throughout the webinar, we're going to be looking at different techniques, different aspects of trading and the market, which is very important to keep in consideration while trading. So, for example, we're going to be looking at exposure levels, leverage. We're going to be looking at, for example, trading plans, and so on and so forth. Now, throughout the webinar, if you do have any questions, you're more than welcome to ask. You can either ask questions through the GoToWebinar software, in which case the questions will come, answer the questions live on the webinar itself. Now, if you're not comfortable asking questions on the webinar, it's absolutely fine. It's not an issue. You can, by all means, send me an email, write a list of all the questions which you have on an email, send it to me, and within 24 hours, I will get back to you with as much information about those questions which I can provide. So let's get started. A quick introduction to IGMFX, to myself and trading, just to get started off with. I'm the market analyst here at IGMFX. Now, as a market analyst, I can assist with anything which is related to itself. So, for example, like today, could be within regards to trade management, risk management, can be within regards to strategies, techniques, analysis, anything which is related to trading and the market itself. If it's related to something which is not to do with the markets and trading, for example, could be within regards to resetting passwords or forgotten usernames and so on and so forth. We do have a support team. The support team is available 24/7, 5 days a week. In which case, if it's something to do with support, it's better to direct those questions to the support team, which is available either by phone call, by email, or by live chat, which I tend to find is the easiest option. A bit about my background. I originally started off as a financial advisor in the UK. That I did for approximately 5 years. Since then, I've worked with quite a few academies, setting up academies, done lots of seminars around the globe as well, on different continents as well. So, for example, South Africa, Nigeria, Cyprus, where our head office is, Greece, Turkey, Romania, Ukraine, Serbia, the UK, and plenty of places around the globe. I do hold a CMAP license, which is a UK-based license, also a CISEC Advanced as well, and I am on the list of approved persons on the CISEC website, if you do want to check that. I've been trading for 8 years. It's coming up to 9 years in a couple of weeks. That does include trading Forex, stocks also, and also commodities at times as well. A quick introduction to IGMFX. I've got a question, so I'll quickly answer the question. Where can we get access to the live chat? If you go onto our website, the website looks like this as well. On the bottom right, so right at the bottom, on the bottom right here, which can't be seen on the screen, but if you go to the website, the home page or any page, on the bottom right, you'll see an option there for live chat. If you click on the live chat, it will ask you a couple of questions like your name, your email address. And then you get, now that you'll continue with anything within regards to the platform, your trading account, and so on and so forth. It's more to do trading education, strategies, techniques, and so on and so forth. To be honest, it's better to direct those questions to myself. A quick introduction within regards to IGMFX as a broker. The main thing really that I want people to be aware of is that we are fully regulated. We are regulated by CFDs, which is a European regulator. This means a lot of things because some people do say to me on occasions, you say you're regulated, but what exactly does it mean? Just so I understand what you're referring to, and it's quite a relevant question. Regulation means by CFDs means that, of course, we're abiding by all European laws. For example, MiFID, for example, GDPR and data protection and so on and so forth. It also means that, of course, we have to report to our regulator, which reports to the European regulators for the Eurozone. And generally speaking, in a more basic understanding, it means that if you do have any issues or there's something that you want to speak to us about, then of course we are here to listen. Whether it's a compliment or complaint or whatever it possibly may be, could be in regards to education, support, anything. Also, just so everybody's aware, we have a very own trading platform which is available on the internet, live on our website. Alternatively, you do have an option to trade via the MT4, which is also known as the MetaTrader 4, which is the biggest trading platform in the world. Now, that is something that we pay and provide to you for free, so that is a massive benefit as well. We do webinars every Tuesday, 6 o'clock UK time. That is every single week. And every week, and hopefully some of you have already seen some of our webinars, the traders which have been with us for a little longer period, you will notice that each week we cover different subjects, different elements and aspects of trading. So for example, we've done webinars based on price action analysis, on technical analysis, economics, on, for example, currency indexes. Today we're looking at trade and risk management. Each webinar will of course look at different aspects of the markets. Now, of course, the more webinars you're going to be looking at, the more educational material you're going to be able to have as a trader, and hopefully improve and grow as an individual, as a trader or professional individual if you are as well. Investment risk. This is what we're going to be speaking about today, but I want everybody to be aware that this information that you can see on the screen is available on the website as well. This I've taken directly from the website. So on the website, on every single page on the website, at the bottom of the page, it's very important for everybody to know when you are trading and when you're looking at investments, no matter what type of investment it may be stocks, it may be commodities, it may be currency pairs, there's always a risk to the investments that you are trading, that you are investing. There's always a risk to that capital. This is why it's important to read this information on the website, understand it, make sure you're comfortable with it before proceeding to a full investment. Now, I did have an individual today who said to me, he did read it, but I didn't fully understand completely, which is absolutely fine. And I understand if you've never traded before, that is definitely reasonable. Feel free to send me an email. Send me an email, say to me, Halis, I've read this information. It doesn't quite make sense to me. Can you explain it to me in more basic terminology, for example? And I'll be more than happy to assist. Alternatively, again, you can email or get in contact with the support team, which of course, again, will assist you, because it is important that you understand and you're comfortable before proceeding to a full investment. Last slide as part of the introduction, and then we're going to start to get to understand trading basics, trade management, risk management as well. The content in this video is for informational purposes only and does not constitute investment advice. IGMFX assumes no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication contains or should be considered as containing investment advice or an investment recommendation or solicitation for the purposes of purchase or sale of any financial instruments. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of IGMFX unless otherwise specifically stated on the video. So hopefully that makes sense. What I'm trying to say, just a quick overview of this slide, is these webinars are here for educational purposes, for informational purposes. They're here to educate. They're not here to give direct trading advice, investment advice, financial advice in any way, shape, or form. Everybody should be aware that here at IGMFX, whether you're speaking to myself, watching the webinar, speaking to the support team, or your account manager, we cannot give you any form of advice. This is the great thing about trading here at IGMFX, because when you are trading, your investments and your trades are fully in your control within regards to how, when, and if you want to enter or close a specific trade and your investments overall, generally speaking. So what are CFDs? This is something which I tend to get asked continuously throughout the week, and it's something understandable because it's not something of a household term or word, should we say, as for example, even if you're not a financial advisor or trader, people tend to know what stocks are, what commodities are, and currencies, and so on and so forth. Whereas CFDs is not such a household term which is used. So it's quite understandable, and it's very important that we understand what CFDs are. Why is it important? Because CFDs is what we are trading here at IGMFX. So it's massively important that we understand fully what they are and what are the different aspects of CFDs, in other words, contracts for difference. CFD trading allows you to speculate on the rising and falling of certain assets without actually having to own the asset itself. So, for example, when you are trading, let's say, not a CFD, but instead trading stocks, for example, Amazon stocks, which is one of the most popular stocks on our platform, people are looking at the price movement of the stock and they're looking to buy at one price, and if the price goes up to a higher price, they're looking to make up the difference between the buy and the sell price. This is what tends to take place in the stock market when you're physically buying the stock itself. However, you do have another option. Instead of buying the stock itself, you can buy a CFD in that stock. So what do I mean exactly by a CFD in that stock? When you are looking at trading the stock, let's say, again, Amazon stock, you can either buy the stock itself, which may be priced at, let's say, $3,500. Instead, you've also got an option to buy a CFD Amazon stock. Now, the only difference is one is the physical stock itself, the other one is not. It's a CFD. However, the price of the two, the price of the contract and the stock, will be the exact same. They will mimic each other. There will be no difference in the price. Now, this basically means that you have the option to buy buy a CFD, and again, still be able to profit and speculate on different types of price movements, whether you're trading that the price is increasing, going to increase on value, or you speculate the price is going to decrease in value. The only difference between CFDs and stocks are that one is the actual asset itself, and the other one is just a contract which is mimicking the price. So some people may ask, and I can already see this question has come up, so I will answer it now because it is relevant to the slide. Why would I trade the CFD instead of the actual asset itself? When you're trading the actual asset itself, there's only one way to make a profit, and the only way to make a profit is that you buy at one price, for example, and you sell at a different price. Okay, this is the only way you can make a profit. Of course, not taking into consideration dividends and so on and so forth. Whereas when you're trading CFDs, There's different aspects which are available, which are unique to the CFD market, which are not available in other markets. When you are trading derivatives like CFDs, you also have the option to speculate that the price is going to decrease in value. When you are not trading CFDs, you do not have the option to speculate the price will decrease in value. If it's decreasing in value, you are 100% making a loss based on the investment. CFDs, though, you have the option to speculate the price would decrease. This is known as buying and selling, the buying and selling concept. Also, you have a very unique aspect to trading CFDs, which is known as high liquidity. When we are looking at high liquidity, we're referring to when you are trading CFDs, you can instantly enter the investment at a click of a button. So, for example, you can enter the investment very simply through the platform by a click of a button. When you want to exit the investment, again, you can do so via a click of a button. It's very liquid. It's a liquid investment. It's a fast investment. Whereas when you're trading other assets, for example, stocks, it can take time to get involved into the investment and can take time to get out of the investment. So, for example, when you're looking at a stock market crash, when the price is actually decreasing in value, it can be quite difficult to get out of stocks and specific investments because nobody wants to buy them from you. Whereas when you're trading CFDs, it's just at a click of a button, you can come out of the investment. So there's different advantages and of course disadvantages as well to trading CFDs. But it's massively important that you understand you are not physically buying the asset itself, but instead you are trading what is known as a CFD, which is a derivative. Now, what exactly makes prices move? When we're referring to CFDs, like I said, the price will mimic the actual asset itself. So if the actual asset itself looks, for example, like this, when we're looking at the price of the CFD, it will look the exact same. There will be no difference between the two, more or less. Why? Because one is mimicking the other. However, it's very important to understand that we need to know what is making the price of the physical underlying asset move. Why? Because when we're looking at that detail, that information, we're able to use it in order to attempt to predetermine how the market is likely to move. Because when we are trading and when we are looking at opening and closing trades, what we are doing, what we must do, is look and analyze the market and look at what is making the price move in order to predetermine how the market is likely to move, so we can position our trade and our investment according to that information. So generally speaking, in very basic terminology, and we're going to look at this, of course, in more detail when we're actually moving on throughout our webinars. Prices are affected based on supply and demand. Now, the easiest out of the two to understand is demand. The more demand there is for an asset, the more likely the price is going to find support and going to increase in value. So, for example, when we're trading stocks, we're looking at information that may entice traders to buy the stock, in which case more people buying and less people selling is going to cause the price of the stock to, of course, increase in value. So this may be a positive and healthy financial figure. So, for example, we've just seen the earnings seasons for US-based companies, in which they release their revenue, their turnover, their quarterly earnings per share, and so on and so forth. Now, these figures may have prompted people to buy the stock or buy more stocks, or to get out of the investment and stay clear of that specific stock. So you can see how this information we can use to interpret whether the demand is increasing or decreasing. Supply also has an effect on the price, as possibly a lot of people already know. The more there is of something, whether it is a commodity like gold, or whether it is, for example, For example, let's say currencies, in which case the more currencies being more notes, let's say, are being produced and pumped into the economy, the more resistance the price is going to receive. So what we're going to be looking at is demand and supply when we're looking at the price movement. How we look and analyze the demand and supply is via different types of analysis. Now, these analyses we've already looked at on different occasions through webinars, in which case we're looking at types of analysis such as technical analysis, fundamental analysis, sentimental analysis, also price action analysis. These are all different types of analysis which we've already looked at as part of our webinars. If you have missed one of our webinars where we've concentrated on analysis, because I don't want to spend too much time on analysis because it's not necessarily today's subject, go to YouTube, type in IGMFX, click on our logo, which looks like this, click on videos, and you can see all of our recorded webinars there, with also different subtitles available if you are interested in looking at different subtitles, watching the webinar with subtitles in German, Spanish, or Italian. So now we've looked at 2 slides, where, to be honest, I wanted to concentrate on something which is very important, something I get asked on quite a lot. Very basic aspects of trading. What I now want to start looking at is today's subject. So what I want to concentrate on as part of this slide is what kind of issues people are seeing when they are trading, because the risks are massively entwined with issues which people may be seeing when they are trading. Now, a lot of the issues are related to the trades itself. So, for example, entering too early into the trade, or entering, for example, too late, so too late on in the trend, for example, if you're looking to trade the trend. But of course, we've also got risks which are unrelated to the trade as well. So what are the issues with entering into the trade too early? This may be, for example, let's say we're looking at a price movement which may look something like this. Now, let's say you want to trade this trend here, which is another trend where we're seeing higher highs in terms of the swing highs and swing lows. Now, the issues which people tend to see with entering too early, so let's say you may be entering in this area of the market, is number one, you spend most of the time in a loss because you've entered too early and the market is moving against you. You may incur higher fees. Why? Because you have to have the trade open longer, in which case you're going to be, if you're keeping the trade open overnight, incurring swap fees, which is also another word, a technical term for overnight fees. You are required to keep the trade open for longer. This is another issue. Must keep your cool for longer, because when you enter and the market is moving against you, a lot of people do get tempted to close the trade, in which case you've closed it on a minus, and then the trade actually moves in your favor after. It's not, of course, wise to keep trades open just because they're in a loss. What you must do is, when you have entered too early and the market is moving against you, you have to reanalyze the market, because if you do believe at some point the market is going to move back in your favor anytime soon, then you may wish to keep the trade open. However, we're going to look at this as part of our techniques later on in the webinar. You may have to close the trade before the market moves in your favor due to your margin. So, for example, if you've got, let's say, an account size of, let's say, 1,000 US dollars, let's say, for example, and the trade is, let's say, minus 800, you most likely are going to have to close the trade because it's eating up that capital. And again, that's another issue within regards to entering too early into the market. Then you've got the other side of the risks, which is entering too late. In which case you're, let's say, for example, entering in this case, this area of the market, which is too late and the trend has ended, let's say. in which case you only spend a very small amount of time in profit before the market starts to move against you. You lose out on most of the profit. You are required to keep the trade open for longer again if the market does move against you, and you still want to try and earn based on the upward trend. If it is going to continue at any point, you may miss out on the movement completely, in which case you have to close your trade in a loss. Trend or predicted movement has ended. So like I said, you just traded too late, the movement has ended, and the market is just going to continue to move against you. Now, as part of this slide, just so everybody's aware, I'm not looking at the solutions. We're just looking at the moment at different issues so far in regards to entering too early and too late into the market. Now, these two tend to be one of the biggest issues, which I tend to see, because a lot of people do come to me and they say to me, let's have a look at my trading account because I've got certain issues, because I'm trading wrong. And a lot of the time it tends to be because they're entering too early or they're entering too late. However, on occasions, we do see risks which are unrelated to trades themselves. Now, these risks could be leverage, which I'm going to look at in coming slides. So I'm not going to concentrate on leverage too much at the moment. But if you are making notes, make a note of leverage, because this is definitely one of the risks which can be involved if it's used unresponsibly. Risks as well, swap fees, which is, like I said, overnight fees. So if you're keeping trades open overnight without any requirement for the trade or any wasn't any necessary need for the trade to be kept open overnight, then you do have the risk of swap fees. High spreads, or if you're trading at times of high volatility and news announcements, very wide spreads. Not managing open trades. We're going to look at this later on in the webinar. Not analyzing the market prior and after opening trades. Again, we're going to be looking at this. So we've got slides specifically related to this in regards to how to avoid this and different techniques which you can keep in mind while you're trading. Not using both technical and fundamental analysis, also price action and sentimental analysis as well. So just basing your analysis on only one part of the market, where in fact the price moves based on technicals, fundamentals, price action, and sentiment as well. So because of that, it's massively important to base your trading on all four types of analysis. Whereas if, let's say, an asset was only based on technical analysis, it would make sense for 100% of your analysis to be based on technical. But generally speaking, most assets, 99% of assets, take all four into consideration. Overexposing your account. This is a big reason why a lot of traders see results that they may not have wanted, because very simply they overexpose their accounts. So again, we're going to be looking at this as well. So basic aspects of trading plans, which you can take into consideration in order to avoid these, especially the first two aspects, from happening. So entering too early, entering too late. And I find these three aspects massively help with our educational role, generally speaking, when we are trading. So a lot of the time when I speak to traders, I said to them, you know, what is your trading plan? How are you trading? And a lot of the time they say to me, I don't necessarily have a plan, which is not necessarily good. You know, people are just analyzing and looking at different aspects of the market, different assets, and they're trading, you know, here and there, depending on these specific conditions in the market. Whereas it's vital that you have a trading plan. And of course, we're going to do lots of different webinars where we're specifically looking at trading plans. Again, if you do need more information and assistance on trading plans, you're more than welcome to get into contact with me. So the first thing you need to take into consideration is what assets, what securities are you going to be trading? Now, you don't want to be an individual where you're trading too many assets for you to keep up with. Bear in mind, the more assets you are trading, so for example, if you're trading 10, 15 20 different assets, you have to be analyzing 20, 15, 10, maybe more different markets. Now that is almost impossible, very difficult to do. So the first thing you need to do is look at different markets, look at stocks, look at currencies, look at commodities, and decide which assets you want to be traded and want to concentrate on. For example, you may say to yourself, I only want to concentrate on one asset, the Euro USD. I only want to concentrate on two assets, the Euro USD and Amazon stocks. These are just examples. So this is exactly what I'm referring to. You have to look and decide to concentrate on one aspect of the market, let's say. It doesn't have to be one industry, so I'm not saying only trade currencies, and trade no more than, let's say, for example, 4, 5, 6 different assets, depending on what you personally feel comfortable and able to trade. So I'll give you an example. Let's say, for example, if I have two sons, let's say, and we're trading, for example, let's say, let's say I've got two sons, and one of my sons is studying at school only mathematics and no other subject, whereas my other son is studying at school 10 different subjects plus mathematics. At the end of the year, when they both take their mathematics exam, the one which only concentrated on maths is most likely 99% of the chance is that he's going to get a higher grade in that exam. Why? Because he only concentrated on it. So what I'm trying to say is, if you're concentrated on a limited amount of assets, or maybe just one asset, as you are trading, you're going to learn much faster and to a higher level. So for example, you're going to learn what's making the price move, what type of trends you are seeing, volatility levels, what is happening in the market. When something does happen, if it's happened before, you know how the price is likely going to react, and so on and so forth. So this is a massive aspect which you can take in order to avoid these risks involved in the markets of basically putting too much on your shoulders. Stop loss and take profits. Most traders use stop losses in order take profit orders in conjunction with stop loss orders. These are basically two tools which can be used as part of your trade in order to safeguard against when the market is moving against you, and also to ensure that if the market does move in your favor, that the trade is going to close. So this is again something which you can take into consideration in order to ensure that you're not going to incur excessive losses, and when the market does move in your favor, it does automatically close, because again, it may move in your favor overnight when you are not looking necessarily at the trade, or maybe on your computer and on your phone. The third thing I want to concentrate on as well is the number of trades and trade sizes. This is something which I've got actually a couple of slides 100% based on this aspect. Now, it's important as part of your trading plan to know exactly how many trades you are going to be opening on a weekly basis and on a daily basis as well. You know how much you are looking to earn, and at the end of each month, what is your target? Based on this, you should know exactly how much you should be trading and how long you are keeping the trades open for. So you want to be looking at your risk appetite, how much you're looking to earn, and look at that based on your weekly and monthly targets. Now, let's say I've hit my target for the week today. I'm not going to look to trade tomorrow, Thursday, and Friday. Why? Because I've hit my target. Whereas if I keep on trading, I may risk the profit which I've made in this week. I wait till the next week. Why? Because I've hit my target. At the same time, when you've, let's say, hit your limit in terms of what you're willing to risk, stop, relook at what happened, relook at why the market moved against you, why you got that trade wrong, and see exactly how you're able to improve this going forward. Now, again, these are aspects of the market which I'm going to look in more detail as we continue in our webinar. Leverage, like I promised, this is something I wanted to concentrate on because you can get risk which is involved with leverage as well. Now, leverage is when the broker is allowing you to control more capital than your actual investment. This may sound like we are lending you money here at IGMFX. However, we are not in any way, shape, or form lending you any money. You can never owe us any capital as well. Bear that in mind. So, for example, if you have invested $1,000 into your trading account and you've got a leverage of 1 to 100, bear in mind leverage is always two figures like so. You have, for example, for every $1 you have invested, an increased buying power times 100. So this basically means 1,000 times 100, which is 100,000. This basically means that let's say you have a stock that you're interested to buy, which is worth $1,000. Instead of only being able to buy one stock, you can actually buy 100 of these stocks. Alternatively, if you do only want to buy just the one stock, it is 100 times cheaper. Why? Because we have increased your buying power. So this is what we're referring to in terms of leverage. Now, leverage, there is advantages and there's disadvantages as well. The advantages is that number one, it is cheaper to trade. There's less initial required margin required to open a trade. This is definitely a big advantage. When the market is moving in your favor, you're earning a higher investment yield, which is also in your favor. The disadvantage is when the market is moving against you, of course, that is a disadvantage because it works in the same way. The market is moving faster, whether it's moving for or against you. So let's look at different scenarios because I tend to find when people do explain leverage, it can be difficult to understand. People don't understand necessarily the difference between having different types of leverage. So let's look at 3 examples here. So we've got an example 1, let's say we've got example 2, we've got example 3 as well. We've got a leverage of, let's say, 1 to 15. A leverage of 1 to 30 and a leverage of 1 to 40. The trade size is always 100,000. So I'm not in any way, shape, or form changing the trade size. So everything is the same. The only thing I'm changing, including the assets, the only thing I'm changing is the leverage. So the first leverage is a very low leverage. We've got a leverage of 1 to 15. We're always looking on these 3 examples, the same type of price movement. We're looking at a price movement of 20 pips on each occasion. However, what can we see which is different? When we're looking at a low leverage, the required capital to open this trade, to open a trade of $100,000 in euros against USDs, we're looking at required capital of over $8,000. This is quite a substantial amount of money. But the profit or loss, depending on whether it's moving for or against us, is only 1.3%. Now that is a healthy percentage based on risk and profit scenario. Now let's look at a different scenario. Let's now look at a leverage of 1 to 30. So this is a slightly higher leverage. Here we can see the required capital is just about 4,000. So again, we can see how that's changed. And also what we can see is based on the same type of movement, the percentage of which I'm risking or looking to earn is now 2.6. It's still not necessarily a massive figure. However, it is an increased figure and something you need to take into consideration. Because if I'm opening, let's say, for example, 100 trades, which is of course a crazy amount of trade, but just as an example, you're looking at 260% of the investment. So that is a very substantial risk which you may be taking. So again, you need to take leverage into consideration there as well. Then we've got a very high leverage here. We've got leverage of 1 to 400. Here we consider advantage. We only need $300, just over $302 to open the trade. However, just on one trade and on the same type of movement, we're risking 35%. Now, a lot of traders ask what level of volatility and what level of leverage level should I be trading with? And this is a question which we cannot answer here at IGMFX. Why? Because we cannot give advice, generally speaking. And also, number two, there's no correct answer because everybody's got a different risk appetite and trying to earn a different figure in terms of their investment yield. So take into consideration your appetite, your risk appetite, and also your appetite in terms of profit in order to decide what levels of leverage you need to be trading with. Now, based on our regulator, SISEC, if anybody is not classed as a professional trader, and if you do want to understand what a professional trader is, you can go to our website and we have all the requirements there. You shouldn't be trading any more than a leverage no higher than 1 to 30. If you are a professional trader, you can indeed have a leverage much higher of 1 to 400. This slide, I just want to again concentrate on the fact that different aspects can move prices. A lot of people tend to see trades which fall into the minus because they're not conducting all three types of analysis. Some people only conduct technical analysis, some people only conduct fundamental analysis, some people only conduct price action. Technical analysis, ladies and gentlemen, when you're looking at technical indicators, so such as stochastic oscillators, such as RSIs, moving averages, Bollinger Bands, these are tools which are used in order to predetermine how the market may move. This is number one. Number two, fundamental analysis. This is analyzing the economy, inflation, interest rates, gross domestic product, for example, political stability, economical growth, and so on and so forth. This is the analysis of this information. Then you got price action, which is the price action, which is the analysis of the price itself, without the use of technical indicators. Now, it's massively important that you're using all three to determine how the market may move. If you're not, you are increasing the risk. Why? Because you may be looking at action, you may be looking at a trend, and the price action may be saying to you, at this point, you should be trading upwards. Whereas if you also looked at fundamental analysis, which you haven't, let's say, you would have just seen that the unemployment rate in, let's say, America increased from 6% to 7%, which is massively negative. Now, because you didn't look at that, you traded and speculated the price will go up. And because of that news, the price actually did this. So because of this information, we are able to use different types of analysis to mitigate the risk, to spread the risk, to ensure that we're not going to willingly enter a trade, in which case if we did conduct all three types of analysis, we would have avoided entering into this specific trade. But because we didn't conduct this, we actually entered into the trade unknowingly that the market would have actually moved against us. So it's very important that we conduct all three types of analysis. Analyzing before and after the market. So far, we've spoken massively about analyzing before the market. It is massively important. I don't want to spend too much time on this because the last 3 webinars we've spoken about this. I just spoke about it now. You have to analyze the market before opening the trade. What I want to quickly mention is that it's even more, if not equally important, to analyze the market after opening the trade. So don't just analyze the market, do a thorough analysis, a good analysis, open a trade, and then just not look at the trade again. Keep on analyzing the market. Why? Because the market changes continuously. The price movement change. the trends change, what is happening in the economy and politics change. So keep analyzing the market until you have closed the trade. When you've closed the trade, then you can sit back and relax because you have secured that profit. Whereas if you're earning a profit, there's nothing saying in the market that the trend cannot change, and the movement on the trade can of course move against us. So again, this is what I am referring to. It's massively important to analyze before, but equally, if not more, after entering into the trade. This is a technique which is used to control and make sure you're trading with an adequate, with sufficient exposure exposure risk management as known in the market. Here I'm looking at the euro against the USD, and I can see we've got a couple of questions. I will answer that, I do promise. Here we've got the euro USD. I've got the chart here. I'm looking to trade $250 in terms of my margin, and I'm, let's say, opening a buy. This technique is very simple, very simple, and it's simply based on looking at different scenarios before opening the trade. So let's say, for example, here I'm looking to open a trade which I'm not going to keep open anything more than 24 hours. In order to do that, I'm going to look at the last 24 hours before deciding how much to trade. Now, I'm going to look at different scenarios. How much can the market move against me in worst case scenarios based on the last 24 hours? In order to determine this, I'm going to look at my price swing lows. Now, the price swing lows is here, here, and also here as well. Now, what I'm going to do, what I must do is, of course, I'm looking to enter here at the current price. I'm going to look at these three scenarios. If the market moves against me to this point, how much would I be losing? If it moves against me to this point, how much would I be losing? If it again, excuse me, if it again moves against me to the third worst case scenario that we can see on the chart, again, how much will I be losing? Now, in order to determine it, click on the buy, click on the stop loss. You don't have to put a stop loss, because I do understand some people don't want to use a stop loss. Like I said, we don't give advice, we don't force people to trade a certain way. How you trade is completely down to you as a trader. Click on the stop loss, even if you're not going to input it into the trade, and put in the different prices. So for example, put in price number 1, put in price number 2, and put in price number 3, for example. Then see what potentially can be the loss. So for example, I'm going to put different losses here. For example, here I've got a loss of 413 euros. I'm trading 250 euros, and I've got a loss of 413. It's a crazy amount based on the amount I'm looking to trade. This basically means I'm overexposing on this trade. So I'm going to lower the trade size. Don't trade one lot. Here I'm trading one lot. Trade half a lot. Trade a quarter of a lot. Trade a mini lot, a micro lot, whatever it may be. You need to lower the trade size till it gets to a figure here on the stop loss, and does give it to you physically what it's looking will lose in terms of actual capital. Put it to a level which you're comfortable with. If it's at a level which you're comfortable with, you are not overexposing yourself. If it's at a level which you're uncomfortable with, you of course need to alter the trade. Now, let's say, for example, I'm looking to open a trade of, let's say, 10,000, or let's say 30,000, and the loss is 413. It may be not risky enough based on my risk appetite, in which case I'm going to increase the trade size. So it works in both ways, not just in terms of our risk, but also in terms of our profit. I may increase the trade now. So the next thing I wanted to speak about is managing your open trades. This is massively important as well. Now, what I would like people to do, generally speaking, is to have a checklist when you open a trade to know exactly what needs to happen in order for you to open a trade. Now, in order to look at this checklist before opening a trade, you check it, you tick each and every box before opening the trade. Now, when the trade is open, you need to conduct the exact same. This is, for example, here I've got an example which I've taken from the MT4. We're looking at different trades here. These are just trades which I've opened at random, just a demo account. And you can see the trades have gone against me here. What I'm going to do is I'm going to work one by one, go through my checklist again to decide if I believe the trade is going to move into my favor. So for example, I may look at, let's say, the Euro USD. It's the first trade, not a big loss. I've relooked at the market and I believe it's going to move into my favor at some point soon. So I'm going to keep the trade open. Next trade, GBP JPY. Again, not necessarily a major loss. And again, I believe the market is going to move in my favor. I keep the trade open. Next trade, USD JPY, a big loss. I may relook at all my checklists and I still believe the market is going to move in my favor. I keep the trade open. Netflix stock, reanalyze. I've decided the market is not going to move into my favor anytime soon. So I decide to close the trade. This is for an example here. So here, like I said, we've got different examples. Here is an example of what you need to do when you've got open trades. This is both for trades in profit and for trades in losses. What ideally you don't want to do as a trader is to have a trade in a loss, and I get to see this on a lot of occasions, where if a trade is in a minus, people say to themselves, I'm not willing to close the trade until the market moves back into my favor. However, you need to take into consideration the market may not move back into your favor. So the market may continue to drop and drop and drop, and your account may not be able to keep up with the price movement against you. In which case, it would have been a much better idea to close the trade here and trade in the opposite direction. That would have been the more sensible thing to do. Now, let's say, for example, you open a trade here, the market does move against you, and you're just maybe worried that the market may move back into your favor. That is absolutely fine as well. You can still close the trade here, okay, for example, and if the market does start to move back up, you can just re-enter again. So like I said, you shouldn't think about it as a way of, if I close the trade, then the loss is final, in which case I've lost that capital. It will be a much better situation than if the market just kept moving against you and that minus becomes a larger figure. So again, this is what I'm referring to in regards to managing trades. This is a technique which is used to assist with volatility levels. So a lot of people say to me, where should I be putting the stop loss and take profit? Because if I'm putting it too close to the market, then 99% of the time it's going to hit the stop loss, in which case, what's the point in trading? And what you can do is measure the volatility levels. So here I've got a 30-minute time frame. I've clicked on my cross here. And what I'm going to do is I'm going to measure the volatility level. So here you can see I'm measuring this wave here. I'm going to measure this wave here, for example. I'm going to measure this wave here, this wave here, this wave here, and I'm going to take the measurement into consideration when I'm putting a stop loss and take profit. So here I can see I'm earning the measurement of the wave, the latest wave, should we say, is almost 26 pips. So 258 points is just under 26 pips. Let's say 26 pips. So when I'm putting my stop loss, it needs to be minimum beneath 26 pips if I'm going to take the volatility levels into consideration. And again, you're going to do this when you're going to be looking at the impulse waves as well. So these impulse waves as well. You're going to use this cross tool here to measure the measurement in order to determine how you may wish to put your stop loss and also your take profits as well. For example, correlation, risk and exposure. So here we've mentioned, this is the very last slide, which I am going to concentrate on, because I understand the webinars take quite a while now, and I don't want to put too much information in on people's plates at the moment. Correlations and risking via exposure. This is something we've spoken about already, exposure and increasing risk through high levels of exposure. What I also wanted to mention is increasing exposure without actually knowing you've increased exposure. Some people may be trading, let's say, the US dollar, and then they may be trading the euro, and they may be saying to themselves, I'm not increasing the exposure necessarily any further by trading the euro. Why? Because the two isn't in any way correlated, should we say. But that's just a very basic example. It is massively important when you're looking at risk to also ensure that you're looking at correlations. What is correlated with the price movement of this asset? Because there are correlations in the market. So when one asset moves up, the other asset moves up as well. When it moves down, the other asset will move down as well. So what exactly am I referring to? One of the biggest correlations in the market is the US dollar, gold, and silver, and other precious metals. So for example, if I'm trading, let's say, the US dollar, gold, silver, palladium, and so on and so forth, let's say 4 large trades, I'm increasing the exposure level on that specific type of movement. Why? Because they're all correlated. If one moves, the other will move as well. So for example, if I'm placing on the US dollar buys, and on the other 3 trades sells, it is 100% correlated, in which case I'm 100% dependent and exposed to that type of movement. Whereas ideally, you want to be spreading, mitigating the risk based on the price movement and on the exposure. So it's very important also when you're picking as part of your trading plan what to be trading, that you take into consideration the correlations. Now that brings us to the end of today's webinar. I'm very thankful for everybody who has taken part and asked questions, and I've got some questions here which I will quickly answer. I've got a question here: where can I get a copy of the recording of the webinar? I will send you a copy of the recording, sir. Also, just so everybody's aware, you will get an automatic email with the recording. Alternatively, you can go to YouTube and watch the recording. I've got another question here in regards to banking services. I'm guessing you're referring between deposits and withdrawals. The best thing to do in regards to that, because it's not related to trading, is to speak to the support team. So those are the last 2 questions which I have as part of today's webinar. In the meantime, ladies and gentlemen, please trade safe, trade responsibly. I do hope you found tonight's webinar educational. In the meantime, have a lovely evening and good night.